Good evening and a very warm welcome to everyone for our session today titled SIP Your Way to Financial Independence, presented in association with ICICI Prudential Mutual Fund. Well, to set the context, capital markets have gained a lot of popularity over the past 5 years, and a majority of investors who park their money into markets invest into mutual funds. Now, it's here that systematic investment plans have emerged as the preferred strategy or mode of investing into markets, and this trend only seems to be catching on further. Now, industry data shows that SIP flows stand at a staggering 12,276 crore rupees per month as of July 2022, as against just about 8,532 crore rupees in January 2020. Now, that's an increase of about 44%. So, even over the past 3 months, or when markets have been tough, SIPs have stayed resilient, which makes them the number one choice for anyone wanting to invest into the stock market. So, what are the reasons for this surge? An investment in mutual funds takes away the stress of timing the market. So, if you look at, say, long term data, equity markets are most volatile in the short term, and hence the best strategy for investors to gain an entry into capital markets is through an SIP strategy, where by virtue of buying at different prices, one can lower the average cost of entry and remove the uncertainty that comes with a sudden drop in market indices. Other advantages include the high levels of flexibility that an investment in mutual funds offers, the discipline it introduces to your savings journey, and of course, the benefits of compounding that it offers. So, as we celebrate crossing 75 years of independence, let's chart out your financial independence journey. I'm your host, Gautam Srinivasan, and it is my pleasure to introduce our esteemed guest for today's discussion, Mr. Dhaval Kapadia. Now, Dhaval is Director and Head of Managed Portfolios at Morningstar Investment Advisor India and leads Morningstar's Managed Portfolios business, as we mentioned. And he will tell us more about mutual fund investments, what kind of investors they're suited for, and how they can help you plan for your retirement. Dhaval, great to have you with us. Thank you so much for joining us on this talk on how our viewers can SIP their way to financial independence. Let's start with the very basics. How do you
Sure.
define financial independence, and why has this term gained so much importance over the past few years?
Yeah. I think that's an interesting point, right? I mean, we talk a lot about financial independence, but if you dig a little bit deeper, the way I would think of this is the ability to spend, to meet your goals or to meet your needs. I think the ability to do that when you want to do it, I think that is in a way financial independence, right? So, without being dependent on others around you. For instance, it could be family members, it could be friends, or it could be anybody else. So without having that external dependence, to make those decisions, I mean, the ability to be able to do it by yourself in a way is something that I would sort of define as financial independence. The other aspect that you just mentioned, and why is it important? I think, and why is it gaining that kind of importance, so to say? The way I would think of this is obviously as in a way, just broadly speaking, as society evolves, as people get into better employment opportunities, as more women enter the workforce and things like that. I think with that, I think the need for financial independence, I think, is clearly felt, right? I mean, and the reason I think it's also important is that not just during your earning periods or during periods when you're working or you're running a business, you're generating a regular income, you obviously want financial independence, but I think it extends beyond that as well, right? And gone are the days when say our grandparents or maybe people before that were looking up to their children to grow up and support them once they grow old, and so on and so forth. I think that is also an important factor to consider, that today I think people need to start thinking about how they can remain independent once they stop generating a regular income, or once they stop sort of working or running the business, or in other words, they retire from regular work as well. So I think that period as well is equally important when one looks at financial independence, so to say.
Absolutely. Indeed. The dynamics of life itself has changed. So should the dynamics of wealth creation, but a part of that changing dynamics is volatility. And of course, that volatility raises a lot of questions because equities are considered a long term asset for wealth creation. But all these events that you hear or read at domestic, at global levels, they drive capital markets in the short term level. So, for a first timer, in your view, how should one go about planning their investments systematically?
Yeah, I think one thing to keep in mind, what you just mentioned in terms of volatility, it's like the nature of the beast, right? I mean, that's the nature of markets by itself, right? They will tend to be volatile. But as an investor, and particularly first-time investors, I think the first step to take is to try and identify the goals that you're trying to achieve, right? And put down goals that you're trying to achieve rather than focus too much on the markets. Put down, it could be, say, a goal where you want to buy a house after a few years, or you want to plan for your retirement, which is probably, to my mind, one of the most important goals that individuals can have. But goals such as those, or you want to buy a car after a couple of years, or whatever those goals might be. If you're a person with a family, you want to plan for your kids' education and so on and so forth. So it's important to first identify those goals. And once you've identified those goals, I think is to put a number to those goals as well, right? I mean, there are a number of financial calculators that are available across. You could talk to financial advisors to try and identify, to put a number to your goal. So I think that's the first step that one should follow. Once one has done that, say, if you're planning for your retirement, say, if you're a 30-year-old person, and you're you plan to retire at the age of 60, right? And so you've got about 30 years to retirement, and you want to create a corpus for your retirement, in that sense, which will sustain you for your post-retirement kind of a period. I think the first thing that you should try to assess is that today, what are your expenses, right? How could they go up over a period of time, right? And I was just doing some calculation, in fact, just before we got into this discussion, and I was just looking at some simple math in that sense. That, say, for instance, today, your monthly expenditure is about 25,000 rupees, right? And that excludes any EMIs and things like that, because those would end probably over a period of time, right? So if you're spending about 25,000 rupees today, and you plan to retire in 30 years, what would be the level of expenses at the end of when you're retiring, in that sense? So that's the first number that you could put out or calculate. And I was just doing this math in that sense. If you assume a 6% inflation rate, this 25,000 rupee per month expenditure could go up to about 1.4 lakhs roughly per month, right? And if you annualize that number, that will be in excess of about 17 odd lakhs or so per annum, right? So and if you were to sustain this level of expenditure post retirement, right? I mean, obviously inflation will ensure that your costs of living keeps going up. Roughly, you need a corpus of about 1.8 crores to sustain your current level of expenses, or your current standard of living, where you're spending about 25,000 rupees per month. So effectively, I think that's one way to start, to try and determine what goals are you trying to achieve, and then work backwards in terms of how much do you need to invest to achieve those kind of goals, right? And as I mentioned, there are a couple of ways to do this. One is, there are financial calculators available today, on many websites. You could also talk to an advisor, who is specialized in this kind of an area. But I would say that is one of the starting points. Once you've done that, I think the next step, which is very critical, is to try and determine that what should be the mix of asset classes that you would invest in to achieve those goals, right? And as we know, and you spoke of it briefly, of course, you have equities, which is a key asset class for long-term wealth creation or wealth generation in a way, right? But you need a mix of different asset classes based on your investment horizon and your risk appetite and so on and so forth, right? So if you've got a goal that's coming up in the next, say, 3 years or so, you wouldn't put all your money into equity. You need to have a mix of equity and debt and probably some other asset classes. So I think that asset allocation decision, in a way, on how much to invest in each asset class, I think, is a second step that you would take. And from there, then you go on to deciding, which, say, if I decide that, all right, I want to put, based on my goals, I want to invest I need to invest about 50% in equity, 50% debt. I mean, a very simplistic way of looking at it. Then I decide that, all right, if I want to take this exposure, how do I go about, building this exposure, or how do I go about building that 1.8 crore corpus that I'm looking at with a 50% equity, 50% debt kind of a portfolio. And that's the next step that you'll take, is that, all right, I need to invest an X amount of money to be able to achieve that kind of a goal. If I put 50% into equity and 50% into debt, and so on and so forth. So I think that's how one could, look at the next step, so to say.
Now that's a clear outline, and most of the time people forget to factor in inflation when they look at post-retirement plans, and they just think about a static corpus. But important that you mentioned about goals, and it's also about looking at it that there are short-term goals and there are long-term goals. So taking that into consideration, let's look at mutual funds. Can you explain first of all the concept of mutual funds, and are these well suited for short-term, medium-term, or long-term investment needs?
Yeah, I think mutual funds are a very simple and a very effective vehicle in that sense of investing into markets. It's like it's just very simply like, if you have an ailment or you have an illness. Obviously, if you have a very minor ailment, you've got a cold, maybe you'll try and take some medicine by yourself. But if if the ailment doesn't get cured, or if it's a more severe ailment, you'll consult professional doctor in that sense, right? A qualified doctor. Similarly, when it comes to building your investments, I think it's a similar concept, right? I mean, if you're looking to create long-term wealth, you really need to work with sort of professional investment managers, or professional advisors, so to say. So that's where I think mutual funds come in. They provide you access to capital markets. It could be equities, it could be fixed income, it could also be international markets as well, or other asset classes such as gold, and so on and so forth. So they provide you access to various asset classes, and you're able to hire, in a way, effectively you're hiring a professional fund manager or investment manager to manage your money, right? In a sense, that's what you're doing, and you're at a pretty nominal kind of a fee. So I would think that's how I would look at mutual funds, as a simple vehicle to invest into capital markets, which will eventually help you achieve your long-term sort of or it could be even shorter, medium-term goals, as we were talking. So the second aspect, in terms of obviously, as we said, as individuals, we would have different goals, right? I mean, some of them could be short-term in nature. Say, so I need money after 2 or 3 years for a certain goal, or after 5 years for another goal, and then a retirement goal could be a longer-term one, right? So within the mutual fund space, you have different options available which suit different requirements, right? So if you need, say, money, even if you need money, say 6 or 12 months down the line, you've agreed to buy a property, or you need to set aside some money for your child's education, which is due in a year or so. You could park that money into liquid or debt funds, which will keep which will ensure that the capital, the risk of erosion of capital is minimal, if practically almost non-existent. And which still generates you a moderate kind of a return. So for various goals, you have different categories of funds as you go up the ladder in terms of your investment horizon. Say if you're looking at a horizon of about 3 to 5 years, one could look at hybrid funds. You have categories such as balanced advantage funds, or you have aggressive hybrid funds or conservative hybrid funds as well. So again, based on your horizon and your risk appetite. And these, the hybrid kind of funds, in very simple terms, create a portfolio which is a mix of equity and debt instruments. So as we know, equity tends to be more volatile over the shorter term, but tends to generate a better outcome or a better return over the longer term. Whereas fixed income tends to be less volatile, but it acts as the as a stabilizing force in your portfolio, so to say, right? So you could select hybrid funds for that kind of a tenure. For a longer term investment horizon, probably a bulk of the portfolio can go into equity mutual funds. Again, out there you have a mix of funds that are investing only into domestic markets, or funds that are investing into international markets as well. And there are a bunch of them available, at this point of time. So, again, you have a mix of different options available within that. Within equity funds as well, again, you have categories such as large, mid, and small, and flexi cap and multi cap, and so on and so forth. So you have a variety of options available, from which to pick from. And as I said, this ideally should be linked to your goals, to your investment horizon in particular, and to your risk appetite, so to say.
Absolutely. Choice is the key word there, especially as the funds universe has expanded dramatically. But let's also look at the mode of investing. And since we're talking
Right.
of SIPs, one of the biggest USPs of SIPs is that they help investors tackle market volatility. So, with all the uncertainty that surrounds capital markets over the past few months, Dhaval, how can investing through SIPs help investors safeguard against sudden slumps?
Yeah, absolutely. And personally, I think SIP is a great route. I myself make bulk of my mutual fund investments through SIPs as such. So I think that's an excellent route. And the reason it's a great route is for a variety of reasons, right? One is, most of us earn our income, at intervals, right? You're not going to get all your income at one point of the year, right? It will be over a period of time. So, you could use some of that to make investments to meet your longer term goals, right? So I think that is one a benefit of SIPs. It helps you stagger or make investments in smaller pockets into equity funds and other categories of funds as well, right?
Hmm.
Uh, I think one key benefit of SIPs, which you were alluding to as well, was the fact that you can try and benefit from the volatility. Is the way I would say put it across in that sense. Is that the way SIPs work is very simple. Is that yeah, it's a concept called as rupee cost averaging. In other words, when the markets are down, right, and obviously the NAV of the fund that you're investing in would tend to also be, would also tend to come down, right? So at that point of time, you're buying more units of a particular fund. Say if you're buying, say if you're investing about 1,000 rupees, if you're running an SIP of about 1,000 rupees into in an equity fund, and if the NAV of the fund when you initiate the investment is at about 10 rupees per unit in that sense, right? And 1 month down the line, if there is a fall in the market, say by 10%, the NAV is going to come down to about 9 rupees or so, right? So in the first month you bought with 1,000 rupees, you bought 100 units of the fund. 1,000 rupee divided by the 10 rupee NAV, you get 100 units, right? In the next month, when the NAV is down to 9 rupees, you're going to get more than 100 units, right? I mean, of that same fund with the same 1,000 rupee investment in that sense. So effectively, what it simply does is it tries to employ that concept of buying low, although you're not selling high, but you're buying when the markets are dipping in that sense. So in a way, it buys more units, as I said, when the markets have fallen, which is a more appropriate, or if not an ideal time, but a better time to buy when the markets have in a way fallen. So in a way, it reduces, you benefit rather from the volatility, because when the markets fall, you're able to buy more units of that same fund, with the same amount of money that you put out in the previous month or in the previous period as such.
Absolutely. The benefits of rupee cost averaging, as Dhaval mentioned. To go more into detail, Dhaval, is there a minimum commitment for SIPs in terms of value as well as frequency of investment? And as an investor, how easy is it for, say, me to skip an installment or, say, defer it for a few months to meet some other unexpected expenses? Take us through all those
Sure.
details.
Sure. So typically, most funds, most equity funds tend to offer SIPs in as small as tickets as 500 rupees, right? But you need to commit yourself for 12 months or so if you're looking at a 500 rupee monthly SIP kind of a ticket. Or the other option is that if you invest 1,000 rupees, it needs to be for a minimum of 6 months. So that is the typical time period that you would need to sort of in a way commit yourself. But fund houses provide that flexibility in terms of deferring SIPs or pausing SIPs as well. But you need to be mindful if you're not able to sort of meet that commitment for a 3-6 month kind of a period, then the SIP might get discontinued. But then, unlike in case of an EMI where obviously you're going to be held probably as a defaulter if you delay your EMIs in that sense. That's not the case with SIPs. There is much greater flexibility that's available. In fact, there are several funds and several fund houses which provide options to increase the amount on a gradual basis. Say you could do it on a year-on-year basis, as well as your income increases. You could suggest that, all right, every year the SIP amount could increase, say, by 10% as well. So there is, in short, I think there's a fair degree of flexibility available, whether it's in the case of pausing an SIP or increasing SIP amounts over a period of time on an automated kind of a basis. So I think there is a fair degree of flexibility available today for investors. Or even in the case of minimum amounts, I think 500 rupees is still is like a very limited sort of amount which one can start with as well.
Absolutely. I'll get to you for the returns picture, but before that, I also want to understand, about systematic transfer plans, STPs. How do
Right.
they help investors safeguard their investments during volatile markets in order to minimize drawdowns?
Yeah. So the SIP, I mean, just to draw a parallel or to compare the two, the SIP and like you said, the systematic transfer plans. So SIP is typically in a scenario where you may not have a lump sum to invest, and say out of your regular income that you or a salary that you draw every month, you put in some money towards that particular investment. Whereas an STP route is similar to the SIP, but the big difference being is that in an STP route, typically you have a lump sum available with you. So for instance, it could be a bonus that you've earned, or it could be from the sale of a property or whatever else, right? So if you've got a substantial chunk of money, a lump sum that you potentially can invest for the long term, the option that's available is instead of putting all that money at one go, as we know, and as we keep talking, markets tend to be volatile. And that's the very nature of markets by themselves, right? So to benefit from that volatility and to not invest all your money at one go, you could put your money in a liquid fund with a specific fund house, and then transfer that money from, say, a liquid fund or an arbitrage fund into the main fund that you're looking at. Say if you're looking at investing into say a large cap and a mid cap fund within a specific fund house. So what you could do is that you could take that lump sum amount that you have, put it, like I said, invested into a liquid fund with that same fund house. You need to invest with the same fund house. All fund houses will tend to have liquid funds as such. So you could park the money there, and then on a systematic basis, you could define, say, many fund houses even offer say quarterly, or I would not say, in fact, monthly or even fortnightly kind of options, where you could transfer the money from that liquid fund and invest it into the eventual fund or strategy that you're looking at for your longer term wealth creation kind of need. So in a way, it staggers your investments into the main fund that you're looking at. So and again, the benefits are similar to that of an SIP in that sense.
Absolutely. Let's also understand the returns that investors stand to gain if they follow that SIP route, because as we discussed earlier, inflation is a big overhang, and beating inflation is, of course, a priority. So when we look at that, equity mutual funds, they have the potential to beat inflation and give higher returns over the long term. So what kind of returns can investors expect from monthly SIPs?
Yeah, I would think that SIP is only the route of investment, right? It's only a vehicle of investment in that sense. And as you mentioned, I think the fact that it is going into equity mutual funds, probably the way to think of returns is that what kind of returns can I generate from equity markets in India, for instance, right? So I would think that over the longer term, one can expect inflation plus returns of about anywhere between 3 to 5%, right? So I would say anywhere between about 11 to 14 or 15%, depending on the type of schemes that you're in. Say large caps could be at the lower end of that spectrum, and mid and small caps could be at a slightly higher end of that kind of spectrum. So I would say over the longer term, one can think of returns in the range of about 11 to 14% coming through from equity funds. Obviously, you'll have periods, and to keep in mind that it's not that this return will be generated year on year, in that sense that you will have periods when the returns could also be negative, and there could be periods when the returns could be substantially higher. So on an annualized kind of a basis, these returns should be in a range of about roughly about 11 to 14% or so in that sense.
Absolutely. There's always ebbs and flows on the market, but if you stay committed, you see the returns, and at the end of the day, everyone wants a stable sort of an income and a portfolio. But talking about stable income, that especially comes into focus for retirees and senior citizens, because they want a stable monthly income. So Dhaval, how can SWPs or systematic withdrawal plans in mutual funds help in an income as an alternate to pension? Can investors choose a fixed amount for withdrawal at a preferred frequency? Your thoughts on this?
Yeah, so a systematic withdrawal is like the opposite of the systematic transfer plan, right? I mean, the systematic transfer, you're investing in pockets or in smaller installments into the fund, Whereas a systematic, so mutual funds do offer this option of systematically withdrawing. So you could define an amount that you want to withdraw at at whatever frequency that you define it at. I mean, each fund house will have, or each fund will have their own options in terms of the frequencies at which you can withdraw, make these systematic kind of withdrawals from the scheme. But I think a few things to keep in mind when it comes to SWP is one is obviously the funds from which you want to withdraw. I mean, one needs to be mindful of that, right? I mean, if it's an equity fund from which I'm doing a systematic withdrawal kind of a plan, because if it's a pure equity fund, the value of that fund could fluctuate a lot with the markets, right? So therefore, you don't want to withdraw too much of money when say the markets are down significantly. So therefore, probably some of the better options to look at when one wants to systematically withdraw money from mutual funds, one can look at some of the categories that we discussed earlier, such as the hybrid funds or the balanced advantage fund kind of categories, which have a balance of equity and debt instruments in their portfolios. So I think those are probably more suitable to an SWP kind of an option. Of course, not to say even the equity funds will allow you to have an SWP, but I think a hybrid kind of fund is probably more suited to an SWP kind of an objective in that sense. And just to round that off, the other point that you mentioned, that can one look at it as an alternate to other fixed income products, or I think this shouldn't be necessarily seen as a complete alternate. I think this can complement some of those kind of options. So you still may need to have a certain portion of your requirement to be met from fixed income kind of products, but some of it can also come through the SWP route. I think one of the main reasons being that with equity being included in some of the funds that you're looking at, it can give you that additional kicker in terms of your return and enable you to beat inflation, so to say.
And that's been a substantial change in narrative, especially for a lot of the retirees, right? Because earlier the thought was always to invest everything move it all into debt. But now it's a balance of debt and equity, because you still need those returns, but do it in a way that your income increases as well and it stays in balance. So, Dhaval, as we look to conclude our conversation, what in your experience are the three most important things that investors should bear in mind while investing into capital markets? Your words of wisdom.
Yeah. So my two bits on that would be, and rather I would say three bits in this case, because you said 3 points as such. Or I would think that one is something that we spoke of earlier briefly, was asset allocation, right? I think that's the most important mantra to follow when it comes to investing in capital markets. Is align your asset allocation to your goals and to your investment horizon and risk appetite, right? I mean, wherever the markets might be, I think that is the primary. I would say that would be the number one thing to keep in mind. I think two other points which investors should try and firmly keep in mind is, one is which is a typical saying, right? Time in the market is more important than timing the market, right? I think therefore you need to have patience when it comes to investing. You can't be thinking that, all right, the markets are down now, and I invested 6 months ago, and the value of my portfolio has gone down, and then you start to panic and wonder what to do, right? So I think you need to have patience. Like we said, time in the market is more important than timing the market. The third most important thing I would say is to avoid chasing performance, right? I think that's a typical I would say a factor that we've seen that impacts investors. They look at certain trends, they look at something that's done very well over the last 2, 3, 4, 5 years, and they think, oh wow, this is done well, and probably they get in at the absolute wrong point of time, and then they are disappointed. So I think don't invest purely based on past performance. You see this across the cycle, right? I mean, a few months ago people were so gung-ho about IT, and now people are just this. You barely see any positive news about it. There's so much of negativity around that kind of theme in that sense. So I'm not saying it's good or bad. I'm just saying that I think that performance chasing is something that one should avoid. When you're constructing a long-term portfolio, you'll have these periods when certain sectors, certain themes do very well, others don't do well. But I think that's part of markets in that sense, and markets are cyclical in nature. So you'll have these like you said earlier, ebbs and flows in markets, which is like we said, the nature of the beast, so to say. So I think three most important things: asset allocation, patience, and stick to your plan, stick to your guns. I mean, avoid performance chasing kind of behavior.
That's the magic formula indeed. Well, that brings us to the end of today's discussion. Thank you so much, Dhaval, for sharing with our viewers your insights. Indeed, it gave us all a new perspective on securing our financial independence with SIPs. And of course, I'd also like to thank ICICI Prudential Mutual Fund for partnering with us for today's session. And last but not the least, thank you to our viewers for tuning in. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day.
Thanks, Gautam.
Thank you, Dhaval.